Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, co-host of Escape from the City on the ABC, and partner of Empower Wealth Advisory. Ben Kingsley, chair of Property Investors Council of Australia and the founder of Empower Wealth Advisory, named the 2018 and 2019 Property Advisory Firm of the Year. Stay tuned as they bring you the insider's guide to property, finance and money management.
All right, folks, welcome back to the Property Couch podcast. G'day, mate. How are you?
Hello, buddy. How you going?
Oh, I'm doing all right. Just acknowledging some of our friends around the country aren't, mate. We've got, as we record, there's been lots of flooding in Queensland, northern New South Wales, through to Sydney. So some people doing it rough and tough. And so, our hearts and prayers go out to people and their families, not only in our own country, but obviously abroad too, Ben.
Yeah, Bryce, a lot can happen in a week, right? We've got Vladimir Putin, who is deranged, I suppose is the best way I'd put it, invading Ukraine. It's not great when you see those types of things happening around the world, and also locally where, people are certainly being misplaced, the humanitarian crisis, people in harm's way. It's a horrible story. So our prayers and thoughts go out to all of those people who are doing it hard at the moment, and hopefully they can stay safe, and we can see a resolution to what has been basically a barbaric act from a dictator that is now hopefully feeling very isolated in one part of his little world.
Yeah, not good at all. So thoughts and prayers internationally and locally in our own country, Ben. We kind of bookended the pandemic with fires and now floods. So it's and often the people that were impacted by the fires have been forgotten since the pandemic's come. So if you're listening to this and you're affected, we are definitely thinking about you. If you're listening to this and you know people that are affected, we are standing with you. So clearly it's an interesting time, Ben. Slight pivot change on that. We went through the week, Ben, celebrating 7 years of the Property Couch. 7 years of you and I,
nice milestone,
being able to riff it once a week, doing something we love, trying to add some value. And I guess one of the joys and the privileges that you and I have is we get to measure our success by the value that we create, and some of the feedback that we've been lucky enough to get has been amazing. And hopefully people have, during that 7 years, we've said it a few times, but if you're new to our community, we started in a podcast where we just thought, why don't we just see if we can help a few people, Ben, because we got sick and tired in our own business of talking to people when it was too late and we wanted to be upstream. The first episode was how to fix bad property investment advice, but we didn't want to fix any advice. We wanted to help people get it right so that it didn't need to be fixed. So happy birthday, mate. 7 years.
Happy birthday to you too. And considering, we now have microphones in front of us, so we recorded that on a little Samsung phone.
Yeah.
And we probably haven't improved much, but the point being is that, podcasts are now a thing. It's great to see that, there's a community out there that shares our mission of aspiring Australians who are, basically saying if it is to be, it's up to me, and they're trying to get ahead, and we're going to try and help them with some fundamental frameworks and approaches in terms of, how we've been able to do it ourselves and pay it forward.
One thing we haven't been successful in 7 years, Ben, is as much as this podcast looks like a duo with you and me, it's a trio because we've got the Stig. But
yes,
mate, early days we got her on a couple of times, but we haven't heard from her of late. We and particularly in the environment of a COVID world, you and I record these every week via Zoom. So you and I aren't even in the same room. But back in the old days, we just used to look at Ibis and ask for some feedback, and we get donuts. So we don't get the same thing. But little annual shout out to our wonderful partner in crime, which is the Stig, that Ibis helps us and makes us look fabulous and does a lot of wonderful things behind the scenes.
And
so,
a growing team in Ardit and Shana as well. So thank you everyone for making a valuable contribution that you all make.
Hey, last week we did a course launch, Ben, and we took on some students for our Start and Build course, and that's awesome. We get to take in a new intake and see if we can add value through that program, through that learning modality, video teaching. So for all of those that came on board our program, thank you. We've been reading out some reviews in the last week. Ben, that course launch, we only do it once a year at that reduced price, so that's done. But I just wanted to read this one out because it actually warmed the Stig's heart. She brought it to our attention, so thank you to her. But this one is a review that we just recently got. Starting again, thanks. Hi, Bryce and Ben. I purchased your book 3 months ago, The Armchair Guide, and then discovered your podcast, which I'm catching up on and still enjoying. After separating 3 years ago and coming out the other side with a fraction of what I needed to purchase another family home and starting a career again, I took the first step away from being frozen with fear, doing nothing, and purchased a 1-bedroom unit 7 months ago, now officially classed as a rent investor. This has been a learning experience, and I wish I had discovered your books and podcasts before doing this, but you have helped me view this as a learning experience and not to let this one be the only one to keep going. Would love to hear more about investing for those who are older. I am 48. Single parents renting while still investing may be an option. A lot of information is geared around owning and leveraging the home you live in to start, which is not possible for me. I cannot see myself being able to afford a home in the suburb where we live, in brackets Metro Melbourne, being a single mum of 2, but I have hope through rent investing that I may still be able to work towards a better future for my children and eventual retirement someday. Thank you to you both, Jane. Mate, that's a wonderful story. And she's right, we can lean into that niche, so we'll take that feedback on board. And I just want to say, Jane, thanks for writing in. Thanks for taking the energy and the effort to do that. And the Stig wants you to have the Start and Build course. So
and so do we.
Absolutely. And if you know anything around here, that if the Stig says, we get nervous about not doing it, Ben. So we've got to make sure that we do as she says. So 1, it's just the right thing to do. And 2, we're looking forward to you getting on board. So send us a note, Jane. The handle is Old Rent Vesta. Let us know. We will make that available to you, and you can dive into that and let us know if that's going to work for you. So very good. Hey, my Mindset Minute theme today, Ben, is I saw this on Instagram, and it was Russell Brunson who wrote this. And it said, growing up, I was told, get good grades so you can get a good job, so you can make good money. But now what I tell my kids is never stop learning, invest early and often, and surround yourself with the right people. So break the cycle and be the change. I like that. I reckon, I am working towards breaking some of the conditioning that I was given as a kid from my dad, who grew up in the shadows of the Depression, shadows of the war, was a pre-baby boomer. Austerity was part of the culture back then, but I needed to look for opportunities to break the cycle. So that resonated with me, Ben. So I want to set that up for folks this week. Doesn't have to be if you've got children or not, but if you do, be the change and break that cycle so that you can set your next generation up with the good habits. So I like that, Ben. Thought it might be good for our community as well.
Yeah, I love it. You can never stop learning, Bryce. We are also students of life ourselves.
Yeah, absolutely. Never stop learning. That is now my mantra. I've set myself up, Ben, as being the identity that I work with now is I am the learner. And I'm gonna and over the long game. Do you know how we always talk about time?
Yep.
If I have that myself as the identity of the learner, time will be my friend. But if I have my identity tied up as I know everything, I'm in a world of hurt and a world of pain, and I will not be able to let time be my friend. So my identity is I'm always learning. I'm always looking for opportunities. I will ask questions. I'll probably make myself look stupid at times in situations, but because I identify as the learner and because I'm prepared to play the long game, I think that's going to serve me. So
I think it will. Very, very well. Very well.
Hey, today's central theme is a data dive, Ben. It's we just ticked over the month this week to a new month. February, we got a bit of data. We don't really have much in January. So we wanted to do a little bit of a dive today, but also have a look at what the recent cycle has offered us and what we will remember the cycle for, because we're going to make a call shortly on what we think is going to happen going forward. But Ben, do you want to give us a bit of insight on what you think the cycle that we've just been through will be remembered for?
I think the messaging here is one of, we did want to have a look at basically how some of the data in February landed before we can get a line of sight. I think I'd mentioned to you, this was one of the most interesting years where there wasn't a really clear path forward for the broader property market in terms of where you might sort of put your stake in the ground and the predictions that you make. And so we now have that data and the sort of story starting to play itself out. And what we do know from pretty much the February broad generic data is that we have passed the peak in terms of the index value of property in Australia, more broadly speaking. We've passed that peak, so we'll talk to that story more. So if that is the case, well, what did we learn from the cycle that we've just been in? And what caused the imbalance between demand and supply that led to effectively the rising tide lifting all ships? And so we wanted to just highlight some of those things so you can remember when you're in a property cycle like that, what were some of the key drivers? And so we knew that interest rates at emergency low levels meant that the cost of money was cheap. And when you do know, everyone, that when money gets cheaper in terms of being able to access that through debt or whatever, you do get asset appreciation. And you see that in terms of business valuations, you see that in terms of real estate as well. And so that's what has effectively happened here. We've seen record low cash rate, money's cheap. And so that was the catalyst for the rising tide lifting all ships. You then whack in a pandemic that resulted in an enormous amount of government incentives, government stimulus, ensuring that people stayed employed. Then you did see the home builder program bring forward what we refer to as this accelerated demand. It's certainly this surge demand is a good way of describing it, where first home buyers enter the market. And this cycle was really led by owner occupiers more so than it was led by investors, if you look at the lending data as well. So, and then the final two, Bryce, are really also important indicators for you as a listener to learn about how you research, because there was a couple of other important things that we saw that really pushed demand into certain locations.
The first of those was definitely population movement, and clearly a couple of states were the huge beneficiaries of that. Clearly the southern states moving to Queensland and over to other parts of the country out of Victoria largely, but in some places New South Wales. And mate, this was your pet commentary throughout the last 3 to 6 months, was the fact that people were buying a second lifestyle property so that they could escape. If they didn't want to do it permanently, they could at least escape temporarily through that second lifestyle property. And in the conversations we had with Nerida and the conversations we had with Nicola, and that was one of your main questions around that. So, but clearly it will be remembered for those things: cheap money, government incentives, population movements, and Aussies looking to add more than one property in that lifestyle location. So, which ended up resulting in the rising tide lifting all ships, typically across the market, across the board, which hasn't been seen since the late 80s in that sort of price movement. And also, we obviously had the pandemic through that cycle, but it was shown to be, apart from the initial panic and fear that was experienced by all of us back in March 2020, it later on proved to be more of a productivity crisis rather than an economic crisis, because it was clearly a case of we weren't able to move in the marketplace given lockdowns, shutdowns and restrictions, rather than it being a sign, like the global crisis where it was a sign of economic activity falling. So
yeah, the management of the health crisis meant that we couldn't move around, right? Because the spread of the virus would be, would kill our most vulnerable in the community. And ultimately that has led to now that easing. So we're moving from a pandemic to an endemic, and we're going to see more movement, and the economy's in pretty good shape. And, it's a nice little sort of segue to talk more about, where we currently sit.
Yeah, Karen, so thanks to our good friends at CoreLogic. They've released the data as at the end of February. So I know that on an audio format, Ben, riffing off tables is often difficult for people to get. But a couple of key things I want to highlight here is just the month by month, which is often interesting to use as an indicator to see how we're going in the short term. Sydney did negative 0.1, and Melbourne did 0%, so largely flat. So that's significant. But if you go to Brisbane, on the other end of the spectrum at 1.8 and Adelaide at 1.5, they are sort of signs of showing where the market activity is at. And that sort of talks, and we're going to talk about this a bit more later, but it goes to talk to where the people are moving and shows where the demand is still showing up. Yeah. So 0.10, Brisbane 1.8, Adelaide 1.5, Perth 0.3, Hobart 1.2, Darwin 0.4, Canberra 0.4, combined capitals 0.3. Interestingly, combined regionals is 1.6, so nationally 0.6%. So interesting. Let's have a look at that from an annual 12-month perspective. Sydney 22.4, Melbourne 12.5, Brisbane 29.7, Adelaide 25.8, Perth 8.6, Hobart 26, Darwin is 12.3, Canberra is 23.8. The combined capitals 19.2. The combined regionals is 25.5. So overall nationally it's 20.6. And then if we just have a quick look at median values, because we do know that median houses have ticked over the $1 million mark in 3 locations, Melbourne, Sydney, and Canberra, but just the median value of dwellings in Sydney is 1,116,000. Melbourne is 700, the better part of 800,000. Brisbane 722.5. Adelaide is better part of 594,000. Perth is 535,000. Hobart 724,000. Ben, for Hobart.
Mm-hmm.
Darwin 495.5. Canberra 909. So the combined capitals is 808,000. The combined regionals is 564,000. And then the average across the nation, Ben, for the median value of all dwellings is $728,000. So there is a bit of a mixed bag in that on a short-term basis, but over the long term, for the 12 months, positive territory in every one of those categories, with the minimum being 13.3 over the 12 months in Perth. So that's significant in anyone's language.
Yeah, it is. And you know, we mentioned it earlier about passing the peak. So what we do see in the CoreLogic data is that the national home values are 20.6% higher over the last 12 months. And that's down from 22.4%. So that's just saying that we did see last month. So that's why Tim and the team at CoreLogic are calling that this is most likely the peak of the cycle. And you can also see clues of that coming up when we actually start to look at some of the samples of the last 3 months of growth, because reading 1 month is very choppy. You should never sort of take a trend from a month.
Yep.
But looking at that 3-month trend, so we did see, you know, as a scene setter, we're not going to go through all of these, but I'll just give you some idea, right? That in Sydney, the last 3 months has seen 0.8 of 1% growth. But the peak 3 months was 9.3%, which was back in May of 21. So if you just quickly cast your vote, I mean, most people can't remember their pandemic periods, right? It's one big blur of a couple of years. But when we got into April and then we, you know, of 2020, we did start to see that, you know, once JobKeeper and all of that started, people's jobs were safe. We did start to see the property market showing signs of life, even though we couldn't move around in certain markets like Victoria and Melbourne. But really, the end of 2020, we started to see that momentum. And the market in early 2021, the first half of the year was white hot. Oh, like that was when we were calling.
We did our hot series at the beginning of that. Remember?
We did. So that's why you see that in that time period. Melbourne peaked with a 5.8 quarterly growth period in April of 2021. So around that same cluster, but we are seeing Brisbane and Adelaide late to that party. So even though Brisbane had a rocking last 3 months at 7.2%, the peak rate for them was actually 8.5 in December of 21. So even there, you know, and we'll see what happens with the floods and confidence that happens after that. Adelaide 6.4 in the last 3 months. But even then, even though that market's still very, very healthy, it did a 7.4 up until January 2022, which is obviously last month. So they give you some indicators in terms of, you know, where the market's at now. Melbourne only did 0.2 over the last 3 months. And as I said a moment ago, it did a 5.8 in April of 2020, April 21. So that's telling us now the regional stuff is the same story. There's only one market where the last 3 months is consistent with the peak, and that is regional South Australia. So maybe a little Victor Harbour action there, or maybe in the sort of Clare Valley and over the back there, those markets are still shining a light. And that did a 6.8% in the last 3 months, but it carried on from a 6.8 up until January of last month. So whereas everyone else is now down off those peaks. So summarising, combined capitals did 1.8, whereas their peak 3-month period was a 7.1% in May of 21. Combined regions was 7.5 and in the last 3 months, and their peak was 6.6 in April of 21. So that's telling us more globally. And this is what we've also got to put context on. This is generally speaking, you can't buy these indexes. You can't buy the market. You've got to buy a property within a market within a market. We're going to get to that story. In Australia overall, 2.7 for the 3 months until the end of February. It peaked at 7% in May of 21 on the back of Sydney and Melbourne being white hot. So what's our takeaway there? Because remember, the messaging we had last week was, take a picture of this, scrunch it up and throw it in the bin. We're now starting to talk about multiple speed conditions and markets within markets, which is where we have been all along in terms of being borderless investing, and these rare occasions when you can look at federal government intervention, you can look at interest rates which carry across all markets and all conditions, you can get these rising tides lifting all ships. Now we're in a situation where, okay, we're going to see different markets at different speeds, into 2022. And that is an interesting story when you start to think about it like that. And we get back to a more, what I would call, normalized property market where some markets are hotter than others.
So it's the peak rate of growth that we're talking about here, Ben. So we're not saying growth has peaked. We're saying the rate of growth has peaked. And I think hopefully people let that actually land, because what we're not saying is there's no future for buying property this year. Because if you circle back to last week's podcast, we talked about time. So it's about positioning yourself. But what we are saying is, if you're speculating, thinking that you're going to get some 12 months worth of growth like you've seen in the past, and if that's the only motivation for you to get into the market, well, then clearly don't play.
And look, and we do know that there are people who follow that mentality of fear of missing out. And it's a really excellent message, Bryce, around, we've always said the best time to get into the property market is when you can afford to get in and you can comfortably hold for the long term. What we are potentially saying is, in terms of the research that you want to do moving forward, is you do want to have a look at the pockets, the markets within markets, and what have they done to identify whether you feel like that peak rate of growth is also meaning that there's less upside. There's still potentially some growth, but how much is left? And that's always crystal ball gazing stuff, very hard to measure, but think of your supply and demand principles. Think about how a balanced market will play itself out in the short term. But if you're playing a long-term game, there is definitely going to be some opportunities across the Australian property market that will materialise. I mean, we'll talk a little bit more about some of those markets into the future. Like Perth is going to go through an interesting next 3 months, next 6 months, as it introduces some higher lockdowns and some more restrictions, because it's got its first real wave of COVID running through Perth as a city. So, but the borders open in 2 days. So there's a lot of pent up demand of people movement that hasn't been able to happen. So it's going to be interesting to see whether there's an influx of people in WA or whether there's an exit of people in WA, which is going to cause the movement of demand and supply taking shape. So, because it's been, I think looking at the numbers, it's been the worst annual performance in terms of capital growth across all dwellings. And I think that has a lot to do with the fact that it's been isolated and it hasn't been able to see demand roll into that area. And so that's what you've got to look at. And we'll talk more about what's happened, to Melbourne, because that's been the third worst performing market, when it comes to annualized capital growth, because of the people movement.
Yeah, they've headed north, Ben. It was effectively last person to leave, turn the lights out. Hey, What was also interesting in the CoreLogic report was around the quarterly growth in sort of bandwidth. So the lowest quartile, the upper quartile, and the middle two. Again, on an audio, we can't see this, but it's interesting because the bar charts are really sort of distinctive with Brisbane, Adelaide, and Canberra, and the other ones not so much. But the interesting part is in both Adelaide and in Hobart, the upper quartile is seeing the most growth, which is interesting because there'll be a ripple flow-on effect from that. Because if the upper quartile is the strongest part of that, at some point where that runs out of steam and affordability, that will have flow-on impacts into that middle quartile, which in most of the other cities, the middle quartile was the most prominent one, which you'd expect. But interesting to see those two patterns, man.
Yeah, there was another little observation. So you look at, say, the ACT, the majority of the growth has been in the bottom quartile, which is 6.7% growth over the 3 months. Now, that's to January, so not to February. So just putting some context. So normally, when you think about ripple effect and affordability consequences and so forth, that those markets eventually do move. Well, if that's the last market to move, what is that telling you? Is it telling you that it's still super affordable and it's just more people wanting to get in the lower market because it's a population movement? Or is it telling you that, that affordability is starting to bite? When I look at Hobart, because my views on Hobart, I mean, if this was the ABC reporting, they would do an overlay of affordability based on the average household income, and they'd probably be reporting to all people from Hobart that 50% of your income goes towards your mortgage, which is unsustainable, right? And it is technically unsustainable. So is that telling us a story that there's still Mexican money or foreign money coming in from mainland Australia? And I suspect it is, and that could be people moving permanently there in looking for an easier, more peaceful way of life post-pandemic. So is it sustainable? That's a big question. Whereas ACT's median house price makes complete sense to me when I think about they've got the highest disposable income in the country, followed by Perth, then followed by Sydney, then followed by Melbourne, followed by Brisbane, then followed by Adelaide. So when you look at those types of income stories, and I think what skews Hobart is you only got a couple 100,000 people living there, or less than 500,000 from memory. So it's not a very big market. I think it's the 13th biggest city in Australia. So it's not a big market. So that's why it's always interesting to look at these quartile breakdowns and see if you can put some narrative around it, and then look at the data behind that to see whether it supports your thesis.
Yeah, you're right. Hobart's median value is 724, Brisbane 722. Just find it hard to see that not returning to its long-term mean. Hey, interestingly too, we talked about this last week, I think, but CoreLogic have said that the value of the residential property market is 9.7 trillion, and the debt is 2 trillion. Okay, so in isolation, 2 trillion is a lot of debt, but against an asset value of 9.7, that's an LVR just over 20%. So I want to highlight that again, because the amount of times we have someone say, yeah, the income to debt ratio in a suburb is now got to a point where it's unaffordable, therefore prices cannot continue to. We'll just remember that.
Yeah.
Just remember that stat, that the LVR across the asset class, across the country, is just a little over 20%. I think that's important. So Ben, looking forward.
Yeah, looking forward, Bryce, I think there's a lot to digest, and this is what today is about. It's basically sort of saying, okay, well, let's see if we can unpack the demand side negatives, the demand side positives, and then we'll look at the supply side negatives and the supply side positives. Now, we're looking at this through the lens of future capital growth. Okay, so please make no mistake that that's what we're looking through, because if you picked up this podcast or if you move forward quickly and you listen to, well, wait a minute, isn't that a good thing? We're actually talking about not values going down, but what's going to keep values going higher, or what's going to put pressure on the current cycle. So we also know that historically, when we go through these spurts of growth, that the market gives some of it back. And so this is where the challenge lives in terms of, where some of this challenge is. So starting on the demand side from a negative point of view, population movement. And so, will the exodus continue? So, we mentioned it earlier, Bryce, around the number of people that were leaving the market. And we did see some, pretty crazy numbers around, some of that population change that was occurring. I think it was, something around almost 50,000 people had left to arrive in Queensland. And that data was only up until March of 2021. So we saw, the population report that came out of government said, up until March of 2021, negative Sydney was 38,900, negative Melbourne was 32,000. So the big winner has definitely been Queensland and Tasmania in terms of those people moving. And before the end of the show, I'm going to share with you the overall population projections that we are seeing in the short term. And I'll also then finish with what the new population projection is going to be for 31-32 for our total population in Australia. But that is a big one, right? Where when you see that population move down, you are basically seeing that people are leaving that market. They're putting their property up for sale, and then they're going into another market to try and buy a property. And so, we did see, and we'll talk more about this on the supply side, but this is a story of that's not someone selling up, upgrading or downgrading into their localized market. Yeah. That's actually
money leaving.
Yeah, movement of people into other markets, and that's what creates demand pressure.
On a low listing environment as well for some. So, and you can see that that's reflected in clearance rates, in particular from Melbourne, coming back to more equilibrium levels rather than those hot levels as well. So on the demand side for the negative, depending on which state you're in, that population movement is one. The other one is, we've talked about this, the home builder passing. So that brought forward a lot of decisions. And so that brought forward a lot of decisions for people who might have been thinking of doing it a year or 2 years later, to take up those incentives. And for some people, they took up the incentives in regional locations, which meant that created demand for those particular ones, which it doesn't exist anymore.
Yeah, so that's right. That demand surge is now past. So we're not gonna see those people come in. And it's a perfect segue into the affordability piece, right? So if things are getting more expensive, costs of materials are definitely going up. So you've got cost of materials, you're going to see inflation play a role in terms of just general living costs are going to go up. And then the big one, the one that the media are going to wrap their lips around and do the fear selling on, is interest rates. And, they don't like a flat property market. That doesn't sell newspapers or doesn't, bring eyeballs to stories. So expect to see a real strong story line over the sort of second half of the year when we see variable interest rates move on the back of inflationary challenges. And of course, Russia's invasion into Ukraine puts further pressure on global oil prices, and oil really is from a supply chain point of view and an input cost incredible at the manufacturing level, but also at the transportation level. So you're going to see that, and obviously that region of the world produces something like 30% of all of the grain, the wheat that we eat. Australia surprisingly produces only, I think, around 4 or so percent. So that's put wheat prices up. So cost of wheat globally is going to increase. If this war continues on for a period of time, that's going to have a more lasting effect in terms of inflationary impact. So when you start to think about the affordability story and the negative news narrative that's going to come off that, confidence is going to take a hit in terms of that. And it's probably also an important point around the time to buy survey. So the Westpac and Melbourne Institute survey, I mentioned it in my economic update a couple of days ago, that we've seen that move 35.7% down from its record reading in 2021 to be now a reading of 84.9. Now, when we talk about these sentiment readings, 100% means there's more optimism than pessimism. So we've obviously got more people who think that a time to buy property is really challenged. And so that, from a demand point of view, says to me that there may not be as much interest in buying from owner occupiers. So where is that demand going to come from? And also, we also have climate impacts, Bryce, in terms of floods and disasters. So
well, that's interesting to watch how that plays out, isn't it? Because the Queensland market has been phenomenally hot and just staying hot for some time. So, but in chatting to the team this week, there will be anxiety that exists for people, particularly if they've been buying interstate around. The last big event was in 2011. Prior to that was 1974, and despite the fact that people say it's a 1 in 100 year event, it's actually not. It's just a 1% chance of it happening every year.
Yep.
And so you've just got a case where that will now play into people's psyche. And if you've had the exodus for people owner occupied, but you've also had a very, very strong demand into that market for investors as well. So they will get some nerves around that.
Well, you think about that, Bryce, also, like, 20,000 houses across Southeast Queensland and New South Wales are underwater. Now that's a damage bill. That's an insurance bill that's higher than potentially the 2011 floods, right? Because it's also taken in northern New South Wales. Now, the demand for builders, the demand for cabinetry, the demand for timber, the demand for all of those things is also going to put pressure on cost of materials.
Yep.
So another example of why potentially building costs and so forth will skyrocket. And it comes back to that ultimate affordability story. So when you're thinking about those types of demand side, it's actually, on the whole, it's a negative read on that demand side. And then we look at, on the positive side, we don't have a lot going for us, but some of these are big things, aren't they, Bryce?
Yeah, well, immigration's one. The planes have been on pause. They've been sitting on tarmacs, and now they're active again. So that is definitely positive on the demand side. What we do know is when they land, they usually have typical cycles. They go into the rental or house share space, get their foot on the ground. But the longer they stay in the country, the more likely they are to move towards home ownership. And then as that happens, so there'll be still some lag as they come and go through that cycle, because we've had 2 years of pause on that. But that will continue to put pressure on. And as we've spoken about a few times, Ben, there is the inevitable selfie that needs to come, where you're standing at the front of your home with the home in the background, that you can send the photo back home to say, here is the justification for the reason why I moved. Yep. And so that will continue to be a very strong driver and a very strong motivation on the positive demand side.
Bryce, I've got some data for you too on that one. So I just thought it's probably a nice little segue. So in 2021, so basically the fiscal year, not the calendar year, negative 100,000 people left our shores. So in terms of immigration, net positive, net minus. Last year, negative 41. So in this current year, 21-22, net negative 41. Forecast for 22-23, what do you reckon? How many coming in a positive sense?
I think it'll get back up to somewhere between 50 and 100.
180,000. So that's what's going to arrive as forecast by the government and Treasury. In 23-24, we're going to be net positive 213,000.
Yeah, back to predictions now.
Yeah, and in 24-25, we're going to be 235,000. Now, we also saw, the Prime Minister literally this week was talking about putting a special concession in there for Ukraine refugees and those people. So taking a higher amount of refugees from war-torn environments. So those numbers could actually go higher rather than lower. And if we think about, some of the bigger numbers that we've seen those numbers as high as net 370,000 in a year. So, you can really see that, as you say, they settle in, they create other jobs, and they need somewhere for shelter, whether that be rent or whether that ultimately means buying a home. And as you say, setting themselves up and telling their family back home that, it's been a good decision for them.
And they'd be moving into a strong economy overall, Ben. So that's important, that the standard of living here is amazing and our economy is strong. But the isolation that we feel often for a lot of Australians, I always think it's hard to see how lucky we are to be here, but it's not until you just describe the refugee status for people in war-torn affected areas. It's just, we are unbelievably blessed to live in this country. So for people to want to come here just for a lifestyle alone, but then as they come into an economy overall that's strong, that also benefits those of us that are already here. And it's never been a better time to be a person looking for work in this country, because the demand is incredible for a lot of areas, given that I love Simon Kustermacher's analogy of the Uber Eats, deleting the Uber Eats app. Do you remember that one, Ben, where he said, in the past we used to just dial up what skilled labor we needed and we'd let it arrive. Now we have to create that internally through the TAFE system and the like. But it's good news for the people that are here, and the wages growth story will be great. And then what we do know is if people, generally speaking, they increase their disposable income, they just increase their disposable expenses, which a higher mortgage often forms a big part of that, which means they'll take on bigger loads, bigger mortgages, take on more demand, which will create more of a positive news story for the property as well. So there's a few things on the demand side, Ben, that are the positive for the capital growth perspective.
Yeah, it's an interesting read, right? You're trying to balance up as I said, those negatives versus those positives. So, one of the sure bets we've talked about already is that we will see yields go higher this year. So as property prices start to slow down, we're already seeing, when you measure yield returns based on, these nosebleed property price growth levels, it looks like the yield's being really terrible and rents aren't going up. But the reality is as those slow down, we will start to see the yield story in each one of those main sort of, top 50 locations around Australia. You'll definitely see rents going up, and you'll see those yield returns starting to improve because of this positive story around immigration and population. But you want to make sure you get your population centre right. You don't want to be investing in a centre where there's an exodus of people. You want to be investing in locations which have really strong projections for future population growth as part of your macro assessment of where to invest.
So on the supply side, Ben, for the positive, there's not a lot to talk about here. We've talked about that a lot before around there's a bunch of think tanks around to try and help with how we can create the extra supply, which also helps with the affordability for a lot of people. But stock is normalizing in some markets.
Yeah.
So you think about the bigger markets, that's starting to hit an affordability peak. So therefore, we'll get into a situation where listings will start to get to match the amount of demand. So that's one thing. And household approvals on freestanding houses, that's above the decade average. So the supply for that dwelling type is interesting. And then the third one here is the cost to build, Ben. So if that's getting more expensive on the supply side, well then that's a positive for capital growth as well.
Yeah, there's some interesting ones in here, right? So cost to build, I mean, property is an awesome inflation hedge because, if cost of materials go up means what you own is effectively going up and not depreciating in value. And it usually flows into the land, as we know, and what we've argued over the long term. The normalization of markets in terms of to balance markets, someone might be arguing, is that a real positive if this is an argument for capital growth? And it's like, well, it helps with when you need to buy in. Like you want to be able to make sure that there's assets there you can buy, and you're not buying into an overheated market or whatever. So that can be seen as a positive for those people who are trying to enter that market. But we also, we do know that, approvals are reducing because of that surge that we had around home builder, that they're really starting to taper off. There's still some freestanding homes doing well, but if you're wanting to buy a unit or into a townhouse development or whatever, they are below that 10-year average. And that also means that, stock levels aren't going to be as high, even though the pipeline of approvals is solid enough that most people think it's a net positive for economic growth. because we do have enough pipeline there, but it may not be enough for the amount of people that want to buy in. So that's why it's a challenging story around the positive news story for supply. What about the negative side?
Well, there's the other one too, Ben, is NIMBYism. So not in my backyard. That from a supply side positive, from the perspective of capital growth, that limits the amount that can come on, because you have a bunch of contesting subdivisions, lots of red tape trying to get that through. It's a slow process, and for affordability and supply, for that to be a positive for the people who want to get in, that needs to move quick. There needs to be people to have an open mind to say, yeah, no problem, come into my backyard, it's no issues. But that is still alive and well. So that's also another one on the supply side.
It's interesting, isn't it? So we've got to try and teach our listeners to understand what we're talking about here. So we're sort of saying lots of supply is actually bad for capital growth. Yeah. So we're not talking about the strong supply being good for growth, because usually if there's more supply coming in, we'll see property prices normalize or slightly correct. And the NIMBYism in terms of not in my backyard is also about the red tape and how long it takes to actually get developments out of the ground. And so from our point of view, that is the positive, because if we don't have that supply arrive and we've got pent up demand and you own assets in that area, normally going to see some capital growth in those areas, so long as there's not an abundance of subdivided land and those oversupply areas or those new greenfield estates, you'll get some overexposure in terms of supply side, and that's where the risk lives. So they're the main ones. Regionally, it's going to be an interesting story on the supply side. So
for negative,
for a negative, I think I think from that point of view, as that we do see a tapering off of, or again, that demand surge slowing down for those people buying lifestyle properties or their second property and commuting to work and so forth. We do know here in Melbourne that it's already been reported this week that more and more people are getting on public transport. You can no longer get a seat, I was hearing, on the trains, because people are returning to the office. And so if they're going to return 2 or 3 days a week, then that commute time between sort of 1.5 hours or 2 hours, or how they set up their working week and their weekends and so forth, is going to be interesting, and whether they want to continue to sustain that and what that impact means for their general living and getting on with life. So that's where the risk lies. Probably not so much in the next 6 months or by the end of 2022, but it's 2023 and beyond, where if you're managing 2 properties and you're not necessarily getting the value out of that second property, what are you going to do there? And for some people, that'd be like, no, the lifestyle elements definitely outweigh the city living. So you might see some more stock in city markets go up, or it might be the other way around, where people return back to the cities and back to their social creature lifestyles. And I think for me, that's probably where I'm leaning more towards seeing a risk of oversupply in the supply side in the coming years in some of those regional markets.
You're not thinking of moving from the big smoke, Ben, to the regions, is what I heard from you there. But
look, I know I wouldn't say I'm not going to do it personally. I quite like this idea of having a retreat property. I don't actually own one that's easily accessed. And I do have the fortunate, my parents live at wonderful Yarrawonga, so
you're always welcome to Torquay, mate. You're always welcome to Torquay. I guess it really comes down to the old classic. We get to see who's been swimming naked, right, when the tide goes out a little bit, because we often say to it, when there's a boom, our buyers team is always saying, make sure you still got some rigor around the asset selection, because, when everything's going, the same applies here across the regions as well, because we've said it all along. For me, the biggest unknown was outside of the commuter belt, what that's going to look like. Well, we're going to find out. Like you say, we're going to find out, not in the next 5 minutes, but we are going to find out exactly where that commuter belt line exists, because it's been a modelling speculation exercise, but now we're going to have some data that proves it soon.
There will, and you know what the game change would also be. So if we do have that roaring 20s decade where we do see, wealth being created through markets, through equity markets, through entrepreneurialism, through all of that type of stuff, you know what, for the exodus that comes out of those markets, there'll be new buyers coming in because they've had a fantastic year in their business, or they've got huge bonuses, or they've got a really strong pay rise. So that could soften the blow. And I say that about all of those sort of commutable markets, that if you've got a growing population more generally, and it's a nice way to finish off this pod, right, in terms of, so let's go and have a look at that long-term projection. So at the time of the report, which was March of 2021, that's the latest data that I can find, 25.7 million was our population size. So not quite the 26 that we thought we'd be at. But it's going to move to 29.3 million by 32. So 2031, 2032. So that's an additional 3.6 million people. And everyone's sort of thinking, all right, well, let's work that out. So 3.6 million at a density of 1.4. So how many properties does that mean? You keep forgetting there are going to be aspiring Australians who do want holiday homes. So there's going to be pressure on those holiday homes. So, people who are, and you're going to see investors who buy their second or third investment property. You'll see some who buy their 12th or 13th investment property. Hopefully, not so many of those into the future. But what you're going to see there is just the new arrivals put pressure on demand. So medium to longer term, my messaging is remain the same. If you're playing the long game and you pick a quality asset in a quality location and you can buy it at the right price and you can afford to hold on to it, magic happens. Just go back to the last episode around
particularly in the third decade,
and particularly in that third decade, as I'm sort of starting to enjoy. It's just, you will see in terms of the dollar returns, you get a really, really strong. And I think there is, a story to tell there around that. And when we do see, if it is a softer 2022, the yield story is going to be one of improvement, where rents are certainly going to go up. But make no mistake, your cost of running your property is going to go up as well. So, of course, you will be, you're running a small business there. So there will be some of those costs pass on to your tenants as well. And especially if governments interfere with you, then some of those costs will have to be passed on, because it's just not reasonably fair that the government would steal some of your rent, and that's part and parcel of basically investing in property, right? So that's the story for me. I think it's a good dive. I think we've sort of why it's been a challenging year where it's not easily to pick the macro. I think you're going to see again some really great stories in markets within markets. I think if the exodus continues out of Melbourne, if you're playing the long game, that could be a good signal that you're buying counter-cyclical. But if you're also hunting in southeast Queensland and the floods and the natural disasters don't cause too much concern for you and you're thinking long game, there's obviously some opportunity. Adelaide's got opportunity. Perth, I suspect, is not far off, settling down and becoming part of Australia again, Western Australia. And when it does, I see some upside for that market in the short term. I think that'll be an interesting market to look at in 2022. And Sydney itself, while it's a perennial winner, it's coming off its peak. So, you just got to look for those opportunity buys as you do in all of those, big centres.
And overarching all this, remember, folks, we're making 10 and 20-year decisions. We're not making 12-month decisions. So some of this headline stuff needs to be put into context to how long we're playing the game. If you're a 12-month outlook, you should be nervous about headlines and those sorts of things. But if you're playing the 10, 20-year game, you shouldn't. So good effort, Ben. Thanks to our friends at CoreLogic. We've dived into their detail. We're going to put the links, Stiga put the links in the show notes. If you want to go into this detail in a bit more depth, they have some publicly available information that we will give credit to and links to, so you can check that out. But obviously we covered what did we learn in the cycle, what was the current status, and looking forward on the demand and the supply side. What does that actually look like? So, good one, Ben. Nice to dive into the data for the first time for the year. Hey, my life hack this week, Ben, super simple. I went and bought some fish and chips with Samuel on my youngest on Friday night. We had a boys' night. Jack, my oldest, was out. Andrew was out. So it's me and him. We went down there and we got the KO because he's fully into NBA at the minute.
Yep.
And he wants to watch all the. I don't know if you've got KO, Ben, but they've got those little minis. Do you?
Yes, I do. I know the ones. Yep.
KO minis is just a big. Well, that probably should be my life hack today for all the sports writing fans that you can get through so many sporting events by just doing the minis. But that's not my hack. So we're sitting there. We're watching Steph Curry, which is his favorite. Did you see Steph Curry hit 16 threes in the All-Star game? 16.
Yeah.
Previous best was 9. So then, so what we did was we just had the sunnies on the bench because we're watching it on my mobile phone. And so the life hack is if you want to watch things and you're getting tired of holding it up, just rest it in your sunnies. So it leans against the lenses and have the arms. And that's your portable phone stand so that you can actually.
I love it. Portable phone stand using your sunnies. That's gold. Very good. Very good. And I can see the picture on our screen here. That is gold.
And of course, as we're returning to more flying, Ben, obviously that's going to help when you're sitting on your laptop desk in front of your seat. That'll help as well. Hey mate, do I dare ask what's making property news?
Well, hasn't this whole episode been what's making property news, mate? Because I haven't prepared anything else. I thought that would be good enough.
Well, mate, it's been the same for 365 weeks. So no, that was a good dive on what's making property news. So there you go, folks. Hopefully that's giving you a bit of insight. What the key takeaway we want to make sure here is we are saying the peak rate of growth has passed. There is nothing in this podcast to say that we think that growth has passed.
But you watch the media just grab it and run with it in terms of the boom is over. And so just, again, take the noise out and just stay true to your plan. Buy the best asset you can at the most affordable price that you can, manage your cash flow well, and go and have some fish and chips on the beach with your son. You know, that's pretty much how you do it, right?
Very good. All right, there you go, folks. So until next week, Ben.
Knowledge is empowering, Bryce, but only if you act on it. And hey, mate, happy birthday. Happy birthday, Elvis. Happy birthday, Ardit. Happy birthday, Shane.
Happy birthday, Property Cow. See you next week, folks.
Hey guys, Bryce here again. Just want to catch you before you go and let you know, if you're new to our community, there are a lot of episodes to catch up on, but it's really important that you start from the very beginning at episode number 1. Because episode 1 through to 20 share all of the foundational pillars and frameworks that you need to know to get the best out of listening to this podcast. So I'd recommend that you start there, and the little tip is to maybe start on 1.5 speed. Now, for those of you that are time poor and don't have time to go back from the beginning, don't worry, we've got you covered as well, because we've created a binge guide that goes through all of the details and makes it easy for you to read and get up to speed very, very quickly. So if you go to thepropertycouch.com.au/fast track, you will be able to download that binge guide and you will be up to speed in no time. And whilst you're there, I've got a few extra goodies for you, because we have our top 5 frameworks that you'll learn on this podcast, as well as the Make Money Simple Again ebook, which will help you with the foundations of basic money management, so you'll have everything you need to succeed in building your own lifestyle design and getting the best out of this podcast. Now, just a reminder that anything that we cover on this podcast is not considered financial advice. We certainly recommend that you get your unique circumstances looked at by your individual advisor, and everything we talk about is just general in nature. To thepropertycouch.com.au/fast track, and you can go and get all those goodies and catch up right away.